My thought process with gold and silver, the market is so much smaller. It's probably not even a tenth of the gold market. I've all along called silver the fuse to the golden nuclear bomb. You cannot have silver go into a default status and gold ignore it. I mean, it would immediately be followed by the gold market. You'd have buyers left and right. We're at the point now. Let me just talk about inflate or die, Richard Russell's, famous saying. From a debt standpoint, because it's a Ponzi scheme, you have to continually create more debt to feed the Ponzi monster. If you don't feed the debt, then the debt collapses. So they're going to feed the debt. But when you feed the debt, what you're doing is you're expanding the money supply. So if money supply is going up 5%, 7%, 10, 11% per year, yet gold and silver production is static or slightly declining, what's happening is, it's the classic, too many dollars chasing too few assets. And it's that way, it's that way system-wide, because GDPs are only growing worldwide at 2%? But yet money supplies are double, triple, quadruple that just to keep that 2% growth. So it's a dangerous situation. And like you said, when gold blows, confidence breaks, and that will literally blow up the entire derivatives complex across the board, which includes all sorts of commodities, all sorts of sovereign treasuries, equity markets across the world. The derivatives market gets taken down when gold becomes unavailable, to deliver.
And silver could be the trigger for that in itself.
I think it will be. Yes, absolutely. Like I said, you can't have a default in the silver market and the gold market ignore it. That cannot happen. Silver comes out of the ground at just under 10 ounces for every 1 ounce of gold. So God's ratio is, let's call it 10 to 1. Man's ratio right now is 88 to 1. For hundreds and hundreds of years, it was 16 to 1. So if God's ratio is 10 to 1, why did man settle on 16 to 1? And that's pretty simple, because years ago, 150, 200, 300 years ago, if you were going to transport capital or pay, you had to transport the metal. And because you had to transport 10 times as much silver by carriage, by horse, by whatever, man discounted silver because of the inconvenience. And I believe in the Constitution, the U.S. Constitution, it's 15 to 1 or 15 and a fraction to 1. And the world settled on 16 to 1, basically to compensate for the inconvenience of having to transport 10 times the weight, 10 times the size of what you could do with gold.
Gold and silver have always been the lifeblood of real money, but their true value has been artificially suppressed for decades. As legendary market analyst Richard Russell once said, "Inflate or die." This simple truth underpins the global financial system, where central banks and governments are trapped in an endless cycle of money printing and debt expansion. If they stop, the whole Ponzi scheme collapses. But if they continue, the purchasing power of fiat currencies erodes, driving people toward real assets like gold and silver. The moment confidence breaks, everything tied to paper money and derivatives will begin to unravel. And when that happens, silver, often overlooked, could be the fuse that ignites the golden explosion. Silver is a unique asset. The market for it is much smaller than gold, less than 1/10 the size, making it more volatile and prone to shortages. While gold is primarily used as a store of value, silver has numerous industrial applications, from solar panels and medical uses to electronics and green energy technologies. Despite its critical role, the price of silver has been artificially suppressed through paper contracts and futures markets. If silver were to enter a default scenario where demand outstrips available physical supply, it would immediately impact gold. Gold cannot ignore a silver default. The two metals are intertwined in both history and markets. The moment silver is no longer available for delivery, the gold market will react violently, setting off a chain reaction in the entire financial system. We are at a point where global debt has spiraled out of control. Governments keep expanding the money supply at rates far exceeding economic growth. Look at GDP figures. Most major economies are growing at a meager 2%. but money supply is increasing at 5%, 7%, even 10% per year. This is the classic case of too much currency chasing too few real assets. Gold and silver production, meanwhile, remains relatively static or is declining. The law of supply and demand is being completely distorted by central banks, and when the system finally corrects itself, the result will be a financial earthquake. The real danger lies in derivatives. The global derivatives market is a ticking time bomb, leveraged to extremes across various asset classes, including commodities, stocks, and sovereign debt. Gold and silver are at the core of this complex web of financial instruments. If confidence breaks in paper gold and silver markets, it could trigger a cascading collapse in derivatives, forcing institutions to cover their positions by buying physical metal at any cost. When that moment comes, it will be too late for those who haven't already secured their holdings. Silver is particularly vulnerable to a supply squeeze. It comes out of the ground at a ratio of roughly 10 ounces for every 1 ounce of gold. Historically, the gold-silver ratio was set at 16:1 for hundreds of years. This was based on practical considerations. Transporting silver was cumbersome, so traders assigned it a discount relative to gold. Even in the U.S. Constitution, silver was officially valued at approximately 15:1 against gold. But today, we see an absurd ratio of 88:1 or higher. This is completely unnatural and a result of financial manipulation. If the market were allowed to function freely, silver should be trading much closer to $275 per ounce, rather than being stuck at artificially low levels. The suppression of silver prices isn't new. It dates back more than a century. The battle between gold-backed currency advocates and those pushing for silver-backed money was one of the defining financial struggles of the late 19th and early 20th centuries. Eastern banking elites favored gold, while Western mining interests fought for silver. The suppression of silver has continued into the modern era through futures markets and derivatives, where paper contracts far exceed the available physical supply. This has created a false sense of abundance, masking the reality that physical silver is becoming increasingly scarce. Today, the world is on the brink of a monetary reset, and silver could be the key trigger. If a true supply crunch emerges where industrial demand competes with investment demand, prices could skyrocket overnight. Imagine waking up to see silver at $200 an ounce. What happens then? Many industries relying on cheap silver would be forced to adjust their business models or even shut down entirely. Electronics, medical applications, and solar energy production would all see dramatic cost increases. This would send shockwaves through the broader economy, reinforcing the already growing trend of inflation and eroding confidence in fiat money.
Where does that put silver today? I mean, even at a suppressed $30 spot price, let's just pick the number, round number, that'd be $275. I mean, in round numbers. I mean, why not? Why would it not be?
Because there's been a concerted effort for 100 years to suppress the price of silver. Actually, you could go back to, I think it was 1897 in the U.S., when there was the big fight between the East Coast, the gold people, and the Western markets that were digging up a lot of silver. I mean, it goes back 125, 130 years, the price suppression. At this point, think about the uses of silver. I mean, there's so many uses. There's industrial uses, there's technological uses, there's medicinal uses, and now we've got the green energy uses. So there's so many more uses for silver, and there's almost no uses for gold other than jewelry and reserves, bank reserves, or individuals holding it. So there's so many uses for silver. What if you woke up tomorrow morning and silver was $200? What would happen to a lot of the products, a lot of the uses that are in place right now? What would happen to those? Some of those, probably many, maybe more than half, those uses, the model wouldn't make sense. I mean, that would bleed through to the entire system, where you would see an inflation of all sorts of goods in all the uses for silver. Would that upset the whole system? I don't know, but I know it would certainly upset a lot of industries. The realization that world trade was something for nothing, the U.S. would import real goods and export dollars, which are nothing. That's the reason, or one of the, the main reasons behind the formation of the BRICS in the first place. I mean, that's why they've joined together. They want free and fair settlement. And fair settlement is not where you give goods and you get a piece of paper that, continually day after day loses value because they're printing more of it every day. The treasuries, the currency of treasuries can and is being diluted. The danger of not being paid back, an outright default is rising, although I don't think that'll happen because they can always print. But there is that danger. And on top of that, then there's the danger that the U.S. Treasury will decide, we don't like what you're doing. Your money is now ours, like what they did with Russia. So I think the Keynesian thought process is flawed from the respect of they don't understand what's the true foundation to the financial world. It's gold. It's not treasury bonds. Although for the time being, it is treasury bonds. But there's going to be a comeuppance that the likes that the world collectively has never seen before.
As we navigate through 2025, it's becoming clearer that global monetary systems are shifting, and gold is playing a central role in this transformation. Governments, institutions, and individuals who understand the historical significance of gold are quietly but steadily increasing their holdings. The aggressive accumulation of gold by central banks is no longer just a matter of speculation. It is a clear signal that confidence in fiat currencies is deteriorating at an accelerating pace. With debt levels reaching unsustainable heights, inflation eroding purchasing power, and geopolitical tensions pushing economies to their limits, it is evident that we are approaching a major financial reckoning. It is often said that history doesn't repeat itself, but it rhymes. We've seen similar scenarios unfold before, with failing currencies, debt crises, and inflationary collapses, leading to an increased demand for hard assets like gold and silver. The reason is simple. Fiat currency is not backed by anything tangible. It relies purely on trust. When that trust erodes, the entire system begins to crumble. If we look at economic history, every single fiat currency has either collapsed or been replaced with a new one at some point. The difference now is that we are seeing this happen on a global scale. A crucial turning point in this financial crisis is the failure of governments to manage their debt burdens. In the US, for example, the national debt has ballooned past $36 trillion, with annual deficits exceeding $2 trillion. This is completely unsustainable, and the only way out for policymakers is through currency debasement, printing more money to service the debt while devaluing the dollar in the process. The Federal Reserve has already pivoted from its previous stance of higher interest rates, realizing that sustaining them for too long would collapse the debt markets. But here's where things get even more interesting. As fiat currencies lose their purchasing power, central banks are buying gold at record levels. China, for example, has been leading the charge, increasing its official reserves while underreporting the actual amount of gold it holds. Many analysts believe that China has stockpiled well over 5,000 metric tons of gold, possibly much more, through state-owned enterprises, the People's Liberation Army, and direct purchases from domestic miners. The same is happening in Russia, where gold production is being redirected into national reserves rather than exported. These nations understand the necessity of holding real assets in an environment where the dollar's global dominance is diminishing. While Western central banks continue to downplay gold's significance, their Eastern counterparts have made it clear that they view gold as the ultimate store of value. The BRICS nations, Brazil, Russia, India, China, and South Africa, are actively working towards a gold-backed settlement system that would bypass the US dollar for international trade. This is monumental because the entire structure of global finance is built upon dollar hegemony. If BRICS nations start settling trades in gold or gold-backed currencies, it could severely weaken the dollar's position as the world's reserve currency. At this point, it's important for individual investors to take note. If central banks, the most powerful financial entities in the world, are aggressively acquiring gold, why shouldn't everyday investors do the same? The average investor still remains underexposed to gold and silver, preferring to keep their wealth in stocks, bonds, or fiat currency. However, these traditional financial assets are losing value in real terms, while gold has maintained its purchasing power for thousands of years. For example, let's consider the US stock market, which is currently sitting at all-time highs despite a deteriorating economic backdrop. This is entirely due to monetary manipulation rather than actual economic growth. Corporate insiders, including executives at major tech companies, have been selling stocks at a record pace. indicating that they know the market is inflated beyond reason. Meanwhile, retail investors continue to pour money into stocks, believing that the market will continue its upward trajectory indefinitely. This is a dangerous assumption. Gold, on the other hand, is still in the early stages of its next major bull market. The last time gold saw a parabolic rise was during the 1970s, when inflation was running out of control. During that period, gold went from $35 per ounce in 1971 to $850 per ounce in 1980, a 24-fold increase. If we apply similar logic to today's conditions, where inflation, debt, and currency devaluation are all far worse than they were in the 1970s, we could be looking at gold prices well above $10,000 per ounce in the coming years. Silver, often referred to as gold's volatile cousin, is another asset that is poised for an explosive move. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is currently above 85. Historically, when this ratio exceeds 80, it signals that silver is severely undervalued relative to gold. The last time this ratio dropped significantly, silver surged from $4 per ounce in 2003 to $50 per ounce in 2011, an astounding 1,150% gain. Given the structural deficit in silver production, the increasing demand from solar energy, electric vehicles, and industrial applications, and the inflationary environment we are in, silver could easily reach new all-time highs within this decade. Another key factor that many investors overlook is gold and silver's role in a financial reset. When fiat currencies collapse, governments often resort to revaluing gold to stabilize the financial system. This has happened multiple times throughout history. In 1933, President Franklin D. Roosevelt confiscated gold from U.S. citizens and then revalued it from $20.67 per ounce to $35 per ounce, devaluing the dollar by 69% overnight. In the 1970s, after the collapse of the Bretton Woods system, gold skyrocketed in response to runaway inflation. We are now entering a similar phase where global monetary authorities may have no choice but to reprice gold much higher to restore confidence in their failing currencies. One of the biggest concerns moving forward is the potential for a full-scale banking crisis. We have already seen bank failures in the past year, and the underlying issues that caused those failures have not been resolved. Commercial real estate markets are collapsing, and banks are heavily exposed to these bad loans. If the banking system experiences another wave of failures, people will realize that their deposits are not as safe as they thought. In such a scenario, demand for physical gold and silver will skyrocket as people rush to protect their wealth outside of the traditional financial system. At the end of the day, the writing is on the wall. The world is moving away from fiat currency dependence, and gold and silver are the primary beneficiaries of this shift. Central banks are preparing for this reality by accumulating physical metal, and individual investors should be doing the same. Waiting until the crisis becomes obvious to everyone will be too late. Once the mainstream media starts openly acknowledging the failure of fiat currencies, gold and silver will already be far higher in price. The time to act is now, while prices are still within reach. For those who are still on the fence, consider this. Gold has never gone to zero. Every fiat currency in history has. The decision to own gold and silver is not about speculation. It is about financial survival. It is about protecting yourself from the inevitable collapse of a debt-based system that is doomed to fail. The choice is simple. Hold assets that are based on trust in governments, or hold assets that have been recognized as real money for thousands of years. The answer should be obvious.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.